Look closely at what just happened, because most people completely miss the significance when it's unfolding in real time. In the last breakdown, I walked through the silver chart step by step, not with predictions pulled out of thin air, but with levels that were already written into the market structure. February 6th wasn't random. That candle mattered because it represented the point where sellers exhausted themselves and buyers finally absorbed the pressure. I laid out the support zone between 72.6 and 70, explained why that range mattered, and why a hold there combined with displacement would open the door to higher prices. That wasn't optimism. That was structure. And now silver is trading around 75.5, reacting exactly where it was supposed to if the market was healthy. This isn't luck. It's preparation meeting information. Here's the uncomfortable truth most viewers don't like hearing. A large percentage of people won't make it through this analysis. They'll leave the moment the information conflicts with their existing beliefs. That's fine. This channel was never meant to be for everyone. It's meant for people who care more about being right than being reassured. People who verify claims instead of repeating headlines. People who understand that narratives are designed to guide emotions, while data quietly reveals reality. If you're looking for someone to tell you everything is fine or that nothing is changing, there are countless other channels for that. This one is different. This is the real John speaking. The people who belong here don't just listen passively. They show up in the comments with additional sources, corrections, and deeper context. That's the baseline. Anything less, and you won't last long in markets like these. Subscribe if that standard resonates. If it doesn't, that's fine too. No pressure, no begging. Now let's ground this in hard numbers. Silver in Western markets is sitting around 75, both spot and futures. In Shanghai, spot is closer to 86, futures near 88. That's an $11 premium from east to west. That gap isn't a coincidence, and it isn't sustainable long-term. Gold is trading near 4,130 in Western markets. Later today, the FOMC minutes drop at 2 p.m. Eastern. That's a known volatility window. The economic calendar isn't just for economists. It tells you when liquidity hunts are most likely, when price is most vulnerable to sharp moves designed to trigger stops and force positioning errors. This is when you stop guessing and start observing. On the lower time frames, the structure remains constructive. As long as buying pressure holds, upside objectives remain in play around 77 and then 78.2. These aren't magic numbers. They're areas where price previously reacted and where liquidity is likely sitting. On the downside, immediate support rests between 74.8 and 73.9. Wicks into that zone are acceptable. That's just the market probing for liquidity. What matters is where bodies close. Bodies closing below 73.9 start to signal weakness and suggest the bounce could be failing. The February 6 candle remains the anchor. Touching its wick is fine. Closing bodies near or below it is not. If we see sustained closes below the 72.6 to 70 zone, then lower prices towards 67 or even below that February wick become likely. With the FOMC minutes approaching, both scenarios are on the table. This is not the moment to predict. It's the moment to let price reveal intent. But charts alone don't explain what just broke open overnight. This is where the framework changes entirely. The United States has quietly developed a critical minerals price floor system and is actively pitching it to allies. This isn't rumor. Multiple agencies collaborated on a mechanism designed to guarantee minimum prices for resources deemed essential to national security. Officials have confirmed ongoing discussions with partner nations. The key word here is pricing. Not subsidies, not tax credits. Guaranteed floor prices. That's what unlocks private investment. And yes, gold and silver were explicitly named in the reaction, with gold jumping sharply and silver surging over $3 almost immediately. This is the inflection point most people don't grasp. A government-backed price floor for critical minerals fundamentally changes the rules of the game. When minimum prices are guaranteed, the paper market loses its most powerful weapon, the ability to smash prices below production costs to flush out producers and maintain artificial scarcity narratives. For years, silver has been treated like a financial punching bag, suppressed through leverage and paper contracts far exceeding physical supply. A price floor doesn't just support prices, it undermines the entire suppression mechanism. This isn't theoretical anymore. This is policy being discussed at the highest levels. When governments decide that access to strategic commodities matters more than short-term price efficiency, the market stops being purely economic and starts becoming geopolitical. Ray Dalio has been warning about this shift for years. He's been explicit about escalating trade tensions, rising fiscal deficits, and the erosion of confidence in U.S. debt. His conclusion is clear: hard assets aren't optional hedges anymore, they're essential. When someone managing capital at that scale frames gold and real assets as necessities rather than alternatives, that's not commentary. That's signaling. Those who understand Dalio's work on debt cycles and currency debasement know exactly what that implies. Institutional positioning is changing quietly and methodically. Now look at what's happening on the COMEX. Registered silver inventories have dropped to roughly 92.2 million ounces. Meanwhile, March open interest sits around 285.3 million ounces. That's roughly 193 million ounces more paper claims than metal available for delivery. Just last Friday, nearly 5 million ounces were pulled from COMEX vaults, with about 800,000 ounces shifted from registered to eligible. Total registered keeps falling. This isn't stabilizing, it's accelerating. Here's where the mechanics matter. March open interest has only declined by about 7.6 million ounces from its peak, dropping from roughly 293.9 million to 285.3 million. At this point in the cycle, the roll needs to accelerate dramatically to avoid delivery stress. Historically, you'd need open interest to fall by roughly 30 million ounces per day. That's not happening. The curve is tightening by the day. Look at the spread. March to May is trading around -52. After accounting for financing, storage, and insurance, the carry-adjusted contango is barely 4.9. That's effectively nothing. The market isn't paying participants to roll their positions forward. If there's no incentive to roll, pressure builds on the front month. That pressure doesn't resolve itself politely. It resolves through price. Every data point is pointing in the same direction. Silver needs to reprice higher to restore balance between paper claims and physical reality. And there are only days left before March settlement begins. This isn't hidden information. The CME publishes this data daily. Anyone willing to check the sources can see it. Many already have. Then you look at the miners. Hecla Mining just reported results that should make anyone paying attention stop and rethink their assumptions. Revenue exceeded $1.4 billion, up more than 50% year over year. Net income came in at over $321 million, roughly 9 times higher than the previous year. Silver production hit 17 million ounces, the top end of guidance. Debt was cut in half. Net debt is now almost negligible. Every operation was free cash flow positive. This is what happens when prices start reflecting actual supply and demand instead of paper suppression. Companies that were barely surviving suddenly look extremely healthy when prices move closer to reality. Jim Rickards laid this out years ago in Currency Wars. Commodities become weaponized during periods of geopolitical realignment. Nations don't secure supply chains for profit, they secure them for independence. What we're seeing with the critical minerals price floor fits that framework perfectly. This isn't free market capitalism in its pure form. This is financial warfare. Strategic resources get government backing because dependence on adversaries is no longer acceptable. Anyone who read that book when it came out knew this phase was inevitable once US-China decoupling accelerated. Now layer geopolitics on top of all this. Reports suggest the Trump administration has moved closer to a potential major conflict with Iran. According to insiders, any military action would not be a limited strike but a large-scale, weeks-long campaign if launched. Diplomatic efforts continue, but gaps remain wide. Meanwhile, military assets are being positioned rapidly across the Middle East. Carriers, warships, fighter jets, weapon systems. This isn't symbolic, it's preparatory. Roughly 20% of global oil flows through the Strait of Hormuz. A prolonged conflict there doesn't just push oil prices higher, it disrupts global manufacturing supply chains that depend on Middle Eastern energy. Silver isn't just a monetary metal. It's an industrial one, and industrial demand is already running a structural deficit for the 6th consecutive year. Energy shocks feed directly into silver demand. Zoom out further. Mining stocks as a share of global equities sit near a 6-decade low. Historically, from 1900 to 1965, mining averaged around 8% of global equity markets. In the late 1950s and early 1960s, that figure approached 10%. Today, it's closer to 1%. That's not normal. That's extreme underweighting. For mining shares to simply return to their long-term average, they would need to rise roughly 8 times relative to global equities, to reach historical peaks closer to 10 times. Governments are reshoring manufacturing. They're rebuilding supply chains. They're prioritizing energy and resource security. None of that happens without metals. None of it happens without fuel. Mining and energy are shifting from cyclical sectors to strategic necessities. Capital allocation starts prioritizing guaranteed supply over marginal efficiency. Charles Mackay wrote about this phenomenon centuries ago in Extraordinary Popular Delusions and the Madness of Crowds. Markets swing between extremes, driven by psychology. Mining at 1% of global equities while governments roll out price floors for critical minerals represents the fear extreme. Maximum pessimism at the exact moment, fundamentals are turning. The majority always arrives late because they react to price instead of understanding structure. Technically, gold miners relative to the S&P are on the verge of breaking out of a decade-long range. In 2011, that ratio was roughly 3 times higher than today. And this gold cycle isn't like the last one. Central banks are net buyers. Trust in fiat systems is eroding. Analysts increasingly compare this environment to the 1970s, when inflation, currency debasement, and geopolitical tension drove capital into hard assets and the companies that produce them. There are bearish scenarios, and they matter. The FOMC minutes could trigger a volatility spike that breaks support. Iran tensions could de-escalate, removing geopolitical premiums. The critical minerals price floor is still in discussion, not fully implemented. March open interest could roll aggressively in the final days as it has in the past. Registered silver, while low, could technically meet delivery if historical norms hold. Mining stocks could remain underweighted if capital continues chasing tech and AI narratives. This isn't investment advice. This is education about financial warfare and structural shifts. When you put it all together, the picture is clear. The US is moving toward strategic commodity pricing with government backing. COMEX registered inventories are shrinking while open interest remains elevated. The roll pace is far below what's needed. Carry costs offer no incentive to delay delivery. Mining profitability is surging as prices normalize. Mining equities are historically undervalued. Geopolitical risk is rising in a region that controls a fifth of global oil supply. Institutional voices like Dalio are openly advocating hard assets as essential. Silver respected the 72.6 to 70 support zone exactly as mapped and moved higher. That matters because it shows the market is responding to structure, not noise. Here's the real takeaway. Price is information, but it isn't always honest information. When paper markets suppress prices below production costs for years, the correction doesn't unfold gradually. It snaps violently when physical reality overwhelms financial fiction. The people who benefit aren't the ones chasing headlines after the move. They're the ones who understood the framework before consensus caught up. Logic beats hype, data beats narratives, and preparation beats panic. The real John, signing off.